Welcome back to Boni's Life, where we turn market chaos into your financial clarity. I'm Boni, and today we're diving into something that's going to fundamentally reshape how you think about money, technology, and wealth creation. We're talking about the 5 cryptocurrency trends that are quietly revolutionizing the financial world in 2025. And if you position yourself correctly, these trends could be your ticket to generational wealth. Now, before we begin, let me ask you something. How many times have you heard someone say they wish they had bought Bitcoin when it was $1 or Ethereum when it was $10? Well, stop wishing and start paying attention, because what's happening in crypto right now is bigger than those early opportunities. We're not just talking about price appreciation, we're talking about fundamental shifts in how the global economy operates. The crypto landscape in 2025 isn't the Wild West it once was. We've moved beyond the speculative mania and into an era of real utility, institutional adoption, and regulatory clarity. The 5 trends I'm about to share with you aren't just theoretical concepts. They're actively reshaping trillion-dollar markets right now, and the smart money is already positioning itself accordingly. But here's the thing that most people don't understand about revolutionary trends. They don't announce themselves with fireworks and fanfare. They start quietly, build momentum gradually, and then explode into mainstream consciousness when it's almost too late to get in at ground level. That's exactly where we are right now with these 5 trends. Let's start with something that might surprise you: stablecoins. Now, I know what you're thinking. Stablecoins, those boring digital dollars that don't move in price? How is that going to make me rich? Well, buckle up, because stablecoins are about to become the most important financial infrastructure of the next decade. Here's what most people miss about stablecoins. They're not just digital versions of the dollar. They're the rails on which the entire future of finance will run. Think of stablecoins as the highways of the digital economy. You might not get excited about asphalt and concrete, but the companies that build and control those highways become incredibly valuable. Tether, the largest stablecoin issuer, isn't just creating digital dollars. They're building the infrastructure for a parallel financial system. And here's the kicker. They're preparing to launch a US-based stablecoin while working directly with lawmakers to shape crypto regulations. When the company that processes more daily transaction volume than Visa starts playing by US rules, you know something big is happening. But the real opportunity isn't just in holding stable coins. It's in understanding how they're reshaping entire industries. Traditional banks are scrambling to offer stablecoin services because they see the writing on the wall. The Office of the Comptroller of the Currency has reaffirmed that banks can engage in stablecoin activities, which is bureaucratic speak for this train is leaving the station and you better get on board. The investment opportunity here is multifaceted. First, there are the direct plays, companies that issue stablecoins, provide stablecoin infrastructure, or facilitate stablecoin transactions. Second, there are the indirect plays, traditional financial institutions that are successfully integrating stablecoin services into their offerings. Third, and this is where it gets really interesting, there are the yield opportunities. Stablecoins aren't just sitting in digital wallets earning 0%. They're being deployed in decentralized finance protocols, earning yields that make traditional savings accounts look like a joke. We're talking about sustainable low-risk yields in the 8 to 12% range, backed by real economic activity. When you can earn 10% annually on your dollar-denominated holdings while maintaining full liquidity, you're not just preserving wealth, you're building it. The smart money is already moving. Major corporations are beginning to hold portions of their treasury reserves in stablecoins, not because they are speculating on price appreciation, but because stablecoins offer instant settlement, reduced transaction costs, and access to global markets 24/7. When Fortune 500 companies start treating stablecoins as superior to traditional cash management tools, you know we've crossed a critical threshold. Now let's talk about something that's happening right under everyone's nose: the convergence of artificial intelligence and cryptocurrency. This isn't just about AI tokens or crypto projects with artificial intelligence in their names. This is about the fundamental restructuring of how AI development happens, and it's creating entirely new categories of wealth. The traditional AI development model is centralized and expensive. Companies like OpenAI require massive amounts of capital, computing power, and data to train their models. This creates a natural monopoly where only the biggest tech giants can compete. But cryptocurrency is changing that equation in ways that most people haven't even begun to understand. Take Bitensa, for example. This isn't just another crypto project, it's a decentralized AI development platform that's turning the entire AI industry on its head. Instead of requiring billions of dollars in upfront capital, Bitensa allows developers to contribute to AI development and get rewarded based on the quality of their contributions. It's like turning AI development into a meritocracy where the best ideas win, regardless of who has the biggest budget. But here's where it gets really interesting from an investment perspective. Bitensa operates through subnets, which are essentially independent communities focused on specific AI tasks. Each subnet has its own token economics, its own reward mechanisms, and its own potential for value creation. We're not just talking about one investment opportunity. We're talking about an entire ecosystem of AI-focused investment opportunities. The numbers are staggering. The global AI market is projected to reach over $800 billion by 2030. And decentralized AI platforms are positioning themselves to capture a significant portion of that value. When you invest in projects like Bitensa, you're not just betting on a single company. Oh, you're betting on a fundamental shift in how AI development happens. Then there's Ambient, which is taking this concept even further. Backed by top-tier venture capital firms like Andreessen Horowitz and Delphi Digital, Ambient is building a blockchain network that integrates AI directly into its core operations. They're not just using blockchain to coordinate AI development. They're creating AI-native blockchain infrastructure. The investment thesis here is compelling. As AI becomes more central to business operations across every industry, the demand for decentralized AI services will explode. Companies will want AI capabilities without being dependent on a handful of tech giants. Decentralized AI platforms offer that independence, and the tokens that power these platforms will capture value as usage grows. But the opportunity goes beyond just buying tokens. The decentralized AI space is creating new types of jobs, new types of businesses, and new types of investment opportunities. You can participate as a developer, contributing to AI models and earning rewards. You can participate as a validator, helping to secure the network and earning fees. You can participate as an investor, backing promising AI projects in their early stages. Here's something that might shock you. The best thing that ever happened to decentralized finance was regulatory scrutiny. I know that sounds counterintuitive, but hear me out. The regulatory clarity that's emerging in 2025 isn't killing DeFi. It's legitimizing it, and that legitimization is creating massive opportunities for those who understand what's happening. For years, DeFi operated in a regulatory gray area. This created innovation, but it also created uncertainty. institutional investors stayed away because they couldn't get comfortable with the regulatory risk. Traditional financial institutions avoided DeFi because they couldn't figure out how to comply with existing regulations while participating in decentralized protocols. All of that changed when the Trump administration adopted a crypto-friendly stance and repealed the IRS's controversial DeFi broker rule. Suddenly, DeFi protocols could operate without being treated like traditional brokerages. This wasn't just a regulatory change, it was a green light for institutional participation in DeFi. The numbers tell the story. According to EY, the number of investors engaging with DeFi is expected to triple over the next 2 years, rising from 24% to 75%. That's not gradual adoption, that's explosive growth driven by regulatory clarity. But here's what most people don't understand about this trend. It's not just about more people using existing DeFi protocols. Regulatory clarity is enabling entirely new types of DeFi applications that weren't possible before. We're seeing the emergence of compliant DeFi protocols that can serve institutional clients, regulated DeFi funds that can accept traditional investment capital, and hybrid DeFi TradFi products that bridge the gap between decentralized and traditional finance. The investment opportunities are enormous. First, there are the infrastructure plays, protocols that provide the foundational services for compliant DeFi operations. Second, there are the application plays, DeFi protocols that are specifically designed to serve institutional clients. Third, there are the bridge plays, companies that help traditional financial institutions integrate DeFi services into their existing operations. The yield opportunities in DeFi 2.0 are particularly compelling. With regulatory clarity, institutional capital is flowing into DeFi protocols, increasing liquidity and creating more stable, sustainable yields. We're seeing DeFi protocols offer yields that are competitive with traditional financial products, but with the added benefits of transparency, programmability, and global accessibility. The smart money is already moving. Major financial institutions are beginning to offer DeFi services to their clients. Traditional asset managers are launching DeFi-focused funds. Corporate treasurers are exploring DeFi protocols for cash management. When the traditional financial world starts embracing DeFi, you know we've reached a tipping point. Now let's talk about something that's going to fundamentally change how we think about ownership, investment, and wealth creation: the tokenization of real-world assets. This isn't just a crypto trend. This is the digitization of the entire global economy, and it's creating investment opportunities that most people can't even imagine yet. Real-world asset tokenization is exactly what it sounds like: taking physical assets like real estate, commodities, stocks, bonds, and even fine art, and representing them as digital tokens on blockchain networks. But the implications go far beyond just creating digital representations of physical assets. Tokenization is solving some of the biggest problems in traditional finance. Illiquid assets become liquid. High minimum investments become accessible to smaller investors. Geographic barriers disappear. Settlement times shrink from days to minutes. Transaction costs plummet. Ownership becomes programmable. The numbers are staggering. Van Eck projects that the real-world asset tokenization market could exceed $50 billion by the end of 2025. But that's just the beginning. Some analysts believe the total addressable market for asset tokenization could reach into the trillions of dollars over the next decade. Major financial institutions aren't just watching this trend, they're driving it. BlackRock, Goldman Sachs, and JP Morgan are all actively developing tokenization platforms and services. When the world's largest asset managers start tokenizing assets, This isn't a speculative experiment, it's the future of finance. But here's where the investment opportunity gets really interesting. Tokenization isn't just about making existing assets more efficient. It's about creating entirely new asset classes and investment opportunities. Fractional ownership of high-value assets becomes possible. Global investment in previously inaccessible markets becomes routine. Programmable ownership structures enable new types of investment products. Consider real estate tokenization. Instead of needing hundreds of thousands of dollars to invest in prime real estate, you can buy tokens representing fractional ownership of properties around the world. Instead of being locked into a single property in your local market, you can diversify across property types, geographic regions, and market segments. Instead of dealing with property management headaches, you can earn rental income through automated smart contracts. The same principle applies to other asset classes. Commodity tokenization allows you to invest in gold, silver, oil, and agricultural products without dealing with storage and logistics. Art tokenization allows you to invest in masterpieces without needing millions of dollars or museum-level security. Private equity tokenization allows you to access previously exclusive investment opportunities. The infrastructure for asset tokenization is rapidly maturing. Regulatory frameworks are being established, custody solutions are being developed, trading platforms are being built, insurance products are being created. We are moving from experimental tokenization projects to institutional-grade tokenization platforms. The investment opportunities span the entire tokenization ecosystem. There are the platform plays, companies that provide tokenization infrastructure and services. There are the asset plays, tokenized assets themselves, from real estate to commodities to private equity. There are the service plays, companies that provide custody, trading, insurance, and other services for tokenized assets. Finally, let's talk about a trend that's flying under the radar but creating massive wealth for those who understand it. Secondary Bitcoin investments. This isn't about buying Bitcoin directly. It's about investing in the growing ecosystem of Bitcoin-related financial products and services. The Bitcoin ETF approvals were just the beginning. We're now seeing the emergence of Bitcoin futures, Bitcoin-backed bonds, Bitcoin mining stocks, Bitcoin treasury strategies, and even Bitcoin collateralized lending products. Each of these represents a different way to gain exposure to Bitcoin's price appreciation while potentially earning additional returns. Corporate adoption of Bitcoin as a treasury asset is accelerating. Companies like MicroStrategy, Block, and Semler Scientific have added Bitcoin to their balance sheets, using it as a hedge against inflation and a tool for long-term value preservation. The Financial Accounting Standards Board updated its guidelines in December 2023, allowing companies to report Bitcoin using fair value accounting, making it easier to show Bitcoin's actual value on financial statements. Here's a statistic that should get your attention. Public companies have already purchased 3.3 times more Bitcoin in 2025 than the total new supply mined this year. That's not speculation, that's institutional demand outstripping supply by a massive margin. The secondary Bitcoin investment ecosystem is creating multiple layers of opportunity. There are the direct exposure plays, Bitcoin ETFs and futures that track Bitcoin's price. There are the leverage plays, companies whose business models amplify Bitcoin's price movements. There are the infrastructure plays, companies that provide services to the Bitcoin ecosystem. There are the yield plays, products that generate income while maintaining Bitcoin exposure. Bitcoin mining stocks offer particularly interesting opportunities. As Bitcoin's price appreciates, mining becomes more profitable, but mining companies also benefit from operational leverage. A 20% increase in Bitcoin's price might translate to a 50% increase in mining profitability. which can drive even larger increases in mining stock prices. Bitcoin-backed financial products are also creating new yield opportunities. Bitcoin can now be used as collateral for loans, enabling investors to access liquidity without selling their Bitcoin holdings. Bitcoin can be staked in certain protocols to earn additional returns. Bitcoin can be used in covered call strategies to generate income. The institutional infrastructure for Bitcoin investing is rapidly maturing. Custody solutions are becoming more sophisticated. Trading platforms are becoming more efficient. Regulatory frameworks are becoming clearer. Insurance products are becoming available. We're moving from a speculative Bitcoin market to an institutional Bitcoin market. Here's where things get really interesting. These 5 trends aren't operating in isolation. They're converging and amplifying each other in ways that are creating entirely new categories of investment opportunities. Stablecoins are becoming the preferred currency for DeFi protocols. AI crypto platforms are using tokenized assets as training data. Real-world asset tokenization is enabling new types of DeFi applications. Secondary Bitcoin investments are incorporating stablecoin yields. The convergence of these trends is creating a multiplier effect that's bigger than the sum of its parts. Smart investors aren't just picking one trend to follow. They're positioning themselves at the intersections where multiple trends converge. That's where the biggest opportunities lie, and that's where the most wealth will be created over the next few years. The 2025 crypto revolution isn't about getting rich quick. It's about positioning yourself in the path of fundamental economic change. These 5 trends represent the early stages of a transformation that will reshape how we think about money, ownership, investment, and wealth creation. The question isn't whether these trends will continue. The question is whether you'll position yourself to benefit from them. The smart money is already moving. The institutional players are already positioning. The regulatory frameworks are already being established. The infrastructure is already being built. Your opportunity is right now while these trends are still in their early stages, while the general public is still focused on price speculation rather than fundamental value creation, while you can still get in before the crowd realizes what's happening. The 2025 crypto revolution is here. The only question is whether you'll be part of it or watch it happen from the sidelines. Choose wisely, because opportunities like this don't come around very often. Remember, this is educational content, not financial advice. Always do your own research, never invest more than you can afford to lose, and consider these trends as part of a diversified investment strategy. But don't let caution turn into paralysis. The biggest risk in a revolutionary moment isn't taking action. It's failing to take action when the opportunity is right in front of you. Until next time, this is Boni reminding you that in the world of crypto, knowledge is your most valuable asset and timing is everything. The revolution is here. Make sure you're on the right side of it.